Welcome to Season 2 of Building Blocks for Apartment Investing. Have you ever wondered what it would be like to speak to a multifamily investor with over 2,000 units in their portfolio? In this episode, we have Clive Davis Esquire on the show. Clive will share with you his strategy on what he looks for an investment, his top 3 KPIs, and much more. Enjoy the show. One way that we bring value is by bringing special guests like the one that we have here tonight, Clive Davis Esquire. Clive has a 20-year background as a corporate transactional lawyer. He purchased his first duplex in 1999. Since then, he has founded a multifamily investment company named Park Royal Capital and expanded his portfolio to nearly 2,000 units. Thank you for coming on the show, Clive.
Thanks for having me, gentlemen. William, Cedric, Dan, happy to be here.
Awesome. So, Clive, if you would, please tell our viewers a little bit more about yourself.
Yeah, so my professional background is as a lawyer. I started out as a corporate transactional lawyer on Wall Street, servicing investment banks and by extension their clients. So I did that for several years out of law school before transitioning to join Pfizer as an in-house lawyer for them. In 2005, I relocated from New York to Atlanta. So I've been here in Atlanta going on 18 years. I later left Pfizer and became a chief compliance officer for a Belgian biopharma with US headquarters here in the Atlanta metro. And at the end of 2016 is when I left corporate life behind and the W-2 with it and made the full-time transition to being a real estate investor full-time, entrepreneur with a focus on multifamily investment. So that's what I've been doing essentially since 2017 to the present day. As you mentioned, William, I have been investing in real estate since 1999, which was my first true real estate investment property that I acquired that I was not living in. At the time, I was in New York City and acquired that property in Southwest Florida, a duplex property. And that really got me started in real estate investment. I held that.
So you just mentioned that now, your focus is more multifamily. So what led you into commercial multifamily?
Yeah, so when I left corporate life at the end of 16, one of the things that I didn't perhaps appreciate as much, but quickly came to realize was that it was and it is much easier for you to acquire commercial real estate than it is for you in commercial multifamily real estate. And as you gentlemen know, that's once you're 5 units and above, that qualifies as commercial real estate. If you're 1 to 4 units, that's considered to be residential. And so the significance of that is that when you go to either acquire your personal residence or a 2, 3, or 4 unit, that is considered residential. So the 2 pieces of information that most lenders are going to ask of you in that first interaction, they're going to ask you for 2 years of tax returns and pay stubs covering the last 30 days. So as soon as you tell them that you are not employed, you are not a W-2 employee, they're going to ask you that same question 2 or 3 other ways, trying to get to the same answer. But basically, you're going to be a peg that doesn't fit into their square. And so once you step into the world of commercial, you're 5 units and above, they are focused not primarily on you as a borrower, but they are focused primarily on the business that you are looking to acquire. In this case, whether it's 5 units, 50 units, 100 units, they're focused on the business and the revenue that business generates and its potential to generate additional revenue based upon whatever your business plan is that you've articulated to them as a lender. They're also going to do their own due diligence on it. So one of the first things that I did after leaving corporate kind of as a proof of concept was I went out and I bought a 5-unit. And again, the 5-unit was as small as I could go and still have it qualify as commercial. And I don't think they asked me what I did for a living. I don't think they asked me what my job was. Again, they focused on the property, the current rents, what I told them, and was trying to influence them to believe or share my belief that the property could increase rents with certain investments being made. Again, they were focused on the property and not me. There was no W-2 for me to show them. And again, that was important to me because I had no W-2 at that point in time. And so obviously I needed to have the down payment and miscellaneous closing costs to bring to the closing table. But without that, I wouldn't have been wasting anyone's time. And so I had that, I knew that I had that, but I was not in a position where I could show them a W-2. So the significance between residential and commercial multifamily is substantial. And for those folks who are still in a W-2 looking to make that transition, I would encourage you to do as much as you can while you are gainfully employed with that W-2, just recognizing that once you no longer have that W-2, you are subject to certain limitations. Not limitations that can't be worked around, but it's just important for you to be cognizant of that.
Okay. So with your transition from residential to commercial, along with the massive success that you had, can you tell us about your multifamily portfolio?
Yeah, so today I'm invested in, it's over 2,000 units now, and we'll close another 295 this month. And I'm a general partner in probably a third of those units. The other units I'm invested as a limited partner, passive investor. And so I'm primarily invested in multifamily, mostly existing properties that were acquired with a business plan, typically a value add business plan where the sponsor or we went in with the idea that we were going to somehow improve the property, either improve operations, improve the condition of units, and ultimately be able to secure higher rents and ultimately force the appreciation, force the value growth of the property. Primarily existing assets, but also some ground up development of multifamily. I'm invested in San Francisco, in Austin, Texas. I'm also invested in DC in an office to multifamily conversion. I'm additionally invested in a portfolio of hotels here in Atlanta, 3 of Fairfield Inn and Suites by Marriott, all within 25 minutes of me, Buckhead, Perimeter, Alpharetta, and that's more of a diversification play. And a lot of the passive investments that I've made into commercial real estate have been done via my retirement fund. So my legacy 401ks that I had at my prior employers, I've been able to leverage or access those retirement funds and invest them in commercial real estate. So that pretty much describes the portfolio. I'm also doing transitioning or kind of expanding my focus to include development. And I'm currently, I and a partner are developing a 90-acre parcel in Chattahoochee Hills, which is about 30 minutes southwest of the airport here in Atlanta. And that's going to be a mixed-use development that will have about 110, 115 homes, and then about 30,000 square feet of commercial retail space. So the development is a newer venture and kind of an addition to my primary lane in business, which is the acquisition of large-scale multifamily.
Wow, that's awesome. That's awesome. Now, being as though you usually invest in existing multifamily properties, what class of multifamily properties do you usually go for?
I don't know if there is a usually, because I would tell you my buy criteria has evolved from the first investment that I did as a general partner anyway, to what I'm looking at today. There's been rapid kind of progression in kind of the types of assets that I pursue and look at today, or that will get my attention. So for example, the first investment, large scale multifamily investment that I did was in 2021, and that was the acquisition of a 244 unit in Morrow, Georgia, that we acquired for about 30 million, and we raised about 8.25 million in equity for that deal. 70s vintage, early 70s vintage, C-class property. And that's not a property that would fit my buy criteria today, as we've kind of climbed the class ladder, if you will, in terms of the quality of assets and the demographics that we're looking for before we're interested in acquiring. So we are in the process of closing a property this month, a 295 unit that is a 2021 construction, new Class A property that we will close later this month. And that's night and day in terms of the class and the demographics and location and what have you. So pretty much today, I don't look at anything unless it's B class or better. And probably the oldest I will go in terms of vintage is 1980s and probably 1990s, if I have my preference.
Okay. With regard to what markets you invest in, you pretty much already given us a good portion of that. But I want to kind of peel back the onion a little bit, because you named some of the higher markets to invest in that you currently are doing deals in. And I just want to see what made you go into these markets, these specific markets. And the ones are Washington, D.C., Austin, and San Francisco, because we know that those particular markets in general has a higher barrier to entry into those markets. So what was your thought process behind going into those type of markets?
Yeah, and so some of those investments that I mentioned were made as long as 5 years ago, or going on 6 years ago. So the thought process at the time probably doesn't resemble the thought process today. But for those passive investments that I made early on, this is 2017, 2018 and beyond, I was investing, even when I was investing passively, I tended to invest in the types of deals that I aspired to do or intended to do at some point in time. And so, when I look at a place like Austin, Texas, and I see and understand and appreciate kind of the growth and the growth story that's been happening there, that particular property, which is a plus or minus 300 unit multifamily development, they position and market that property as somewhere that if you're living in Silicon Valley and working in Silicon Valley, especially now with COVID and COVID's arrival and hopefully departure, it's been marketed and positioned as we have a lower cost of living here in Austin, Texas, relative to pricier markets like California and specifically Silicon Valley. Those jobs lend themselves to you working anywhere in the world that you have Wi-Fi, so why not come to Austin, Texas? And so what was already a very vibrant market with the arrival or onset of COVID only became an increasingly in demand market. So that's what made that particular investment attractive. Also, Tesla relocating its headquarters from California to the Austin metro, if you will, or the perimeter of that metro is yet another thing in their favor. The DC investment was an opportunistic, just capitalizing on what's happening in the office sector of commercial real estate. we know that we have a housing shortage in aggregate in the US, and DC's no different on that front. So taking existing office space that is underutilized and converting that to multifamily in a very strong area. This happens to be in Tenleytown, for those of you who have any familiarity with DC. It's next to a major university. And so converting that office into 140 multifamily apartments just struck me as a no-brainer. So again, I look at each investment and make an assessment as to, does the business model make sense? Is there demand for the product? And then I go from there. In terms of markets that I'm focused on, in terms of deals that I want to be doing as the lead general partner, my primary focus is on the Atlanta metro for acquiring apartment communities, but I will do deals outside of the Atlanta metro if an existing partner brings an opportunity to me and I am persuaded that it's a compelling business case to do that investment. But that's rare. Again, that's usually only with someone that I already have an existing relationship with, I'm already doing business with, and they've identified a great opportunity that is outside of a market that I'm focused on.
Along that line, can you walk us through your multifamily strategy or what it is you look for you to say, okay, this is a deal that I want to invest in?
Yeah. So our model is primarily a value add business model. So by value add, as I said earlier, it's recognizing an underperforming asset that may be underperforming because of ownership, lack of investment, poor property management, a number of things. For whatever reason, they're not currently maximizing the potential of the asset. So when we look at those opportunities, take that first property that we acquired, the 70s vintage, 244 unit in Morrow, the our largest floor plan there is a 3-bedroom, 2.5 townhome. And so when we acquired that property, I think the rent on that was $1,100. I underwrote that deal and said if we made certain amount of investment in the units and amenities, we'd be able to get $1,250 for that same unit. Turned out that we've been able to get substantially more than that, and not necessarily having to make the full investment that we expected we would before we closed and became the owner of that property. We go in with a plan of, there's a problem, we have a solution, here's how we're going to improve the performance of the property. And then we go in with the business plan and we execute on it.
Okay. Now, with all the turmoil that the economy is in right now, have the interest rates affected your multifamily buying strategy?
Well, I think anyone in this space has been affected. You can't help but be affected because the interest rates, and it's not just the interest rates, but it's the leverage that you're able to secure for your deals. So a year or two ago, you may have been able to secure up to 80% leverage, meaning that if a deal cost 10 million, you might have been able to borrow 8 million. Today, you may not get 6 million. You may struggle to get 6 million in debt on that property. And so, the combination of leverage and interest rates has made impacted the entire market. And then also, if you look at the number of transactions that were done in 2021, in 2022, and what we've seen in the first quarter plus of 2023, there's been a substantial fall off in the number of transactions. And that's primarily being driven by what's happening in the interest rate environment, namely that we've had 10, including the May 3rd rate increase by the Fed. We've had 10 increases in the current cycle. And so that's somewhat unprecedented for us to see rates move up as rapidly as they have in the last year plus. And so that's had a chilling effect on the transactions, number of transactions. So you have sellers who are saying, my property's no longer worth what it was worth a year ago, at least on paper. I'm not going to sell into this market. And then you have some people saying that I can't, my plan was to refinance the asset or the property, and I can't refinance on the same terms that I underwrote to. And so therefore, we're kind of in a holding pattern where a lot of deals, there's a disconnect between what buyers think the value of those properties are and what sellers are willing to let those properties go for, because they know that, look, a year ago I could get X, and now they're saying they're offering me 85% of X. I don't want to sell, so let me figure out a way to hold on. And so we're in that kind of holding pattern right now. And now that it looks like the Fed has paused its rate increases, we'll see come June. I think June 14th is their next meeting. But if they do, in fact, pause, that will be a good thing for the market, just in terms of the certainty that it introduces back into the marketplace.
Mm-hmm.
Yeah, I totally agree. I think it's gonna have to happen, or I can't say gonna have to, but it'll definitely allow the market to upright itself a little bit. So with your investments, what are the 3 top KPIs that you look for you to say thumbs up, I'm going in on this?
Yeah, and I meant to get to this earlier, so thanks for reining me back in, Cedric. So KPIs, so because our business model is a value add, the number one KPI, if a broker, anyone sends me a deal and says, hey, Clive, take a look at this is really compelling, you should invest in it, you should buy it, you should consider it. The first thing I want to know is, obviously I've got my criteria, my buy criteria. So if it doesn't fit my buy criteria, I'm not even going to invest the time looking at it. But assuming that it meets my buy criteria, the number one KPI for me is, what is the median household income within a 1, 3, and 5 mile radius of the property? And the primary focus is on what is the median household income within that 1 mile radius. And the reason I focus in on that, because if you're engaged in a value add business plan, you're basically saying that the rents are currently, I'll use my example from earlier, they're $1,100 today, and I'm going to invest a certain amount, let's call it 10,000, into a certain percentage of the units, and I'm going to raise the rent on those units. I need to know that once I raise those rents, whether I raise them 150 or 200 or whatever the case may be, I need to know that either the existing residents are going to be able to afford and absorb that increase, or if they can't, that we have other prospective residents or tenants who can move in and take advantage of those opportunities, these newly renovated units. So once I know what the median household income is today, I can, with a very simple napkin calculation, I can determine how much we can push those rents and still be within the reach of the average prospective tenant within that 1 mile radius. So just to give a quick example, most landlords, whether you're renting a 5 unit, 50 unit, 100 unit, most landlords, most owners follow a 3X rule, which says if the rent is $1,000, you should be making at least $3,000 a month in income in order to qualify. So that translates to a 3 times 12, $36,000. So let's say that I'm looking at an apartment community and the median household income is $40,000 within a 1 mile radius. And if I'm looking to increase the rents to $1,250 a month, that gets me up to $45,000. So if you apply the 3X rule, times 3, then times 12, that gets me up to 45,000. However, if the KPIs are telling me that the median household income within a 1-mile radius is 40,000, I'm going to be outpricing most of the residents within that radius. So I'm going to factor that in terms of whether or not I even want to pursue that opportunity, whether it's viable or not. So hopefully that makes sense. But it's a quick rule of thumb. You can do that calculation in your head and determine, is this something even worth pursuing? If the existing population is already struggling with rents, and you don't have a viable population who can kind of take their place, so to speak, then that's not a good opportunity. That's not a good value add opportunity. Part of my buy criteria is I don't look at anything like you've got to be at least a 50,000 median household income, which corresponds with kind of class B and better assets. If you think about it, you've got to be at least a 50,000 for me to want to take a further, deeper look.
So Clive, with over 20 years of experience in this field, what has been the key to your success?
Yeah, so the experience, all those 20 years isn't in this field, but I would say the 20 years of experience from corporate life, first as a corporate transactional lawyer and later as a compliance executive, and even as a smaller scale real estate investor to what I'm doing now. The key to success for me is just discipline and focus. There's a lot of shiny spoons out there, and if you're someone who is easily distracted by shiny spoons, you will chase every opportunity and catch none. And so for me, discipline and focus are two key things in the success that I've had inside and outside of real estate.
That was a lot of information. In our next episode, Clive will share tips on who to invest with, how to control your schedule, and a few pitfalls that you want to watch out for. Don't forget to press the alert bell when you subscribe, and I'll see you on the next episode.